technical word. All right, time for our ETF Spotlight. Brian Sullivan back at our headquarters. He's taking a look at the energy sector following better than expected earnings from ExxonMobil and Chevron. And Brian, a sector you follow closely, you had a very good January in the stock market as well.
It did. I mean, listen, we're going to get to the data here at the end, David, because if you were smart enough or lucky enough to buy at the bottom, you've made a lot of money. Either way, let's get into those numbers first, then we'll get to that. You had Exxon and Chevron earnings, ironically, kind of both come out on the same day. The stocks are responding well. It's helping the Dow. Let's do Exxon first. They're bigger. Quarterly earnings up 73% year over year. EPS $1.41. The consensus was just $1.08. If you wanted to nitpick, Exxon revenue is a little bit light of the estimates, but the market is still pleased. Their downstream revenues, upstream is what you pull out of the ground. Downstream is what you sell back to the people. Downstream revenues well in advance, $2.73 billion. The estimate, $1.43 billion. Big beat there. Also, they benefited from a lower tax rate, 32%. That was lower than their 40% average tax rate in the first 3 quarters, so the tax cut helping a lot. Now on to Chevron. EPS, a beat there as well, $1.95. The consensus, $1.87. Both production and sales did beat estimates on Chevron. A lot of growth in the Permian. Remember, Chevron is not only one of the biggest players, it's one of the oldest players there as well. They also announced a new $25 billion buyback, no set term limits. That replaces the old 2010 buyback. Now, both those stocks are up, and that's helping the XLE ETF. That's the biggest energy ETF. Those two stocks are 40% of the XLE. The other 29, there's 31 stocks in it, make up the other 60%. So those two stocks really drive the whole bus. Now, to your point, David, if you were smart enough or lucky enough to buy in the December lows, that XLE, it's up 20% from December 26. Unbelievable. Another ETF to watch, the IYE, the iShares U.S. Energy. Exxon is a skosh larger percentage in this one. Now, Exxon CEO Darren Woods was on CNBC today, and he was talking about how there is still some economic expansion going on, but the key for ExxonMobil remains in keeping costs down.
As we were coming into 2019, we anticipated some economic slowdown. Still expansionary, but some slowdown there. Frankly, we don't run the business or try to build it on a projected demand or projected oil price. Across the portfolio, we're looking at developing resources at the lowest cost of supply to industry, and then let the prices go where the prices go and where the supply-demand balances take them, and then make sure that we're successful irrespective of what price environment we find ourselves in.
Now, both Exxon and Chevron did have strong cash flow, guys, but I want you to keep this in mind, okay? Crude oil started the quarter at about 75 a barrel. It collapsed all the way to 45, so the average was about 60. Okay, now I know oil popped in January, had a great month, but we're still below at 53 bucks a barrel, the fourth quarter average. So things could look a bit different in the first quarter, by the way, from an analyst perspective. Chevron, the better bet. The average price target there, $1.34. That's about 14% upside, $134. They've got an overweight rating. The Exxon consensus rating is hold, with about 10% upside seen on a price target of $82.42. So analysts say Chevron is the better bet right now.